Hey everyone, and welcome to The Explainer. Today, we're taking a really fascinating journey together. Our goal? We're going to look at the roadmap for building a solid wealth starter portfolio, literally from the ground up. Now, if you already follow personal finance, you know there is a ton of noise out there. But today, we're just cutting right through all of it. We're going to trace the exact path from your daily budgeting habits all the way to executing actual index fund investments. It's really about creating a machine that works for you. I am absolutely pumped to explore exactly how this is built, so let's get into it.
Building a wealth starter portfolio isn't some chaotic guessing game. It's actually a highly structured, step-by-step process. So here's our roadmap for today. First, defining your wealth. Then, funding your future. After that, the power of time, followed by your starter portfolio. And finally, staying the course.
Okay, let's dive into this with a number that completely changed how I look at investing. 90%. According to the S&P Dow Jones Indices, roughly 90% of actively managed funds fail to beat the S&P 500 over a 20-year period. I mean, really think about that for a second. These are highly paid professionals trying to pick winning stocks, and they lose to a simple, broad market index 90% of the time. This shocking statistic proves exactly why a simple, passive portfolio is the absolute ultimate goal. You don't need to outsmart the market, you literally just need to participate in it.
All right, moving on to step 1, defining your wealth. What does that actually mean to you?
Before we even think about buying a single stock, we have to ask a crucial question. What is your personal definition of wealth? You know, we so often think of like private jets and giant mansions, but is it really that? For you, does wealth maybe mean having the funds to put your kids through college without taking out massive loans? Or is it having enough cash for a down payment on a house? Or honestly, is it simply the peace of mind that comes from paying your bills on time every single month without an ounce of stress? Defining your specific target is really the only way you'll know when you've hit it.
So once you have got personal definition in mind, we need a solid way to measure it. The crucial point here is how we ground this abstract, kind of fuzzy idea of wealth into a simple, undeniable math equation. And that equation is your net worth. Your net worth is simply your assets, the cash, investments, and property you actually own, minus your liabilities, which are the debts and loans you owe. Tracking this single number month over month and year over year is the truest measure of your financial progress. Basically, if that number is growing, your wealth machine is working.
Which brings us to part 2, funding your future. This is where we lay the foundation.
You simply cannot build a strong investment roof if you haven't poured the solid foundation of a budget, right? You need capital to invest, and to find that capital, we use a beautifully simple framework, the 50-30-20 rule. This completely takes the complexity out of budgeting by using the rule of 3. Instead of agonizing over tracking 50 different hyper-specific spending categories, you just organize your money into 3 simple buckets: 50% for your needs, 30% for your wants, and 20% dedicated to your savings and investments.
Let's briefly break down what actually goes into each of those buckets. Needs are your absolute must-haves. If you can literally look at an expense and say, I cannot survive without this, like rent, utilities, healthcare, and basic groceries, it goes right here. Wants, on the other hand, are your choices. Think restaurant meals, vacations, or maybe paying for 5 different streaming subscriptions you barely even use. And then there's that final 20%, savings. This is the absolute lifeblood of your wealth machine. That's the cash you're setting aside for future goals, your emergency fund, and eventually your starter portfolio.
But wait, before we go dumping that 20% into the stock market, we have to address a really stark contrast. On one side of the ring, we have high-interest credit card debt. And let me be super clear about this. There is absolutely no investment out there that will give you guaranteed returns that outweigh the destructive, wealth-draining power of high-interest credit card debt. You absolutely must pay that down first. On the flip side, though, we have the incredibly constructive power of an automated emergency savings account. Setting up automatic, recurring deposits to a bank or credit union protects you from unexpected expenses, ensuring you don't fall right back into that debt trap.
All right, moving into part 3, the power of time. This is where we see compound interest actually get to work. And this brilliantly illustrates the underlying framework of our wealth machine. The formula here is beautifully simple. Regular investments plus time equals wealth. By putting your money to work, the interest you earn literally starts earning its own interest. It's like a snowball rolling down a massive hill. This undeniably proves that starting early and allowing your money to compound over decades easily beats trying to chase high-interest risky bets later in life. You're just letting time do all the heavy lifting for you.
Now, if you want a quick mental math trick to see exactly how fast your wealth machine is accelerating, you can use the Rule of 72. It's super easy. You just divide the number 72 by your expected rate of return. The result gives you approximately how many years it'll take for your investment to completely double in value. So, for example, if you expect an 8% return, 72 divided by 8 means your money doubles every 9 years. It's just an incredible, simple way to visualize the timeline of your financial goals.
Let's move to section 4 and see how this builds. Your starter portfolio. Getting into the actual investments. Remember that shocking 90% statistic from the beginning? Well, that is exactly why we focus heavily on index funds. Here are 4 top index fund picks for beginners: VOO, VTI, SWPPX, and FXAIX. Now, pay close attention to those expense ratios. That's the yearly fee the funds charge you to own them. They are incredibly low. We're talking all under 0.05%. VOO and FXAIX track the S&P 500, giving you a slice of the 500 largest U.S. companies, while VTI holds over 3,500 stocks for just massive broad market diversification. With fees this low, you get to keep the vast majority of your compound growth.
Now you might be wondering, why are VOO and VTI called ETFs, while SWPX and FXAIX are mutual funds? What's the actual difference? Well, ETFs, which stands for Exchange Traded Funds, trade throughout the day just like individual stocks, and they often have much lower minimum investment requirements. That makes them super friendly when you're just starting out. Mutual funds, on the other hand, settle just once a day at the closing price. Honestly, both hold the exact same kinds of stocks, but mutual funds are very often the primary vehicle you'll find offered inside workplace retirement accounts.
Speaking of accounts, where should you actually be buying these funds? Well, if your job offers a 401k with an employer match, start exactly there. That match is literally free money. Let me repeat that, free money. You should always take it. Now, if you don't have a 401k, or if you've already maxed out that match, your next building block is an IRA, an individual retirement account. IRAs offer massive tax advantages that help your money grow even faster, basically keeping the tax man away from your beautiful compounding interest.
So how do we actually execute this plan? It takes just 4 actionable steps, and you can usually knock this out in under an hour total. Step 1, open a brokerage account on a platform like Robinhood or Public. Step 2, link your bank and fund the account. Step 3, search for your chosen index fund ticker, let's say VOO, and place your order. But Step 4? Step 4 is where the real magic happens. Set up recurring buys. By automating your purchases, you're practicing something called dollar cost averaging. This smooths out all the bumps of market volatility over time. You literally just set it and forget it.
And that brings us to our final section, Part 5, Staying the Course, How to Protect Your Wealth.
Look, building the wealth machine is really only half the battle. Now we have to protect it from the absolute biggest threat out there, ourselves. Beginners frequently sabotage their long-term returns with just a few really common habits. First off, avoid chasing past performance. Last year's winner is rarely next year's. Second, do not panic and sell during market dips. Markets naturally recover over time, and selling just locks in your losses. Third, avoid holding too many overlapping funds. Owning VOO and VTI just creates duplication. It doesn't actually give you better diversification. And finally, never ignore the fees in your 401k plan. A simple portfolio of just 1 or 2 broad index funds will easily outperform some complicated high-fee mix.
Now, what's really interesting about this is that protecting your portfolio brings us right back to exactly where we started. To keep funding those recurring index fund buys, you have to continually study your daily spending habits. Remember that 20% savings bucket we talked about? It is fueled entirely by the intentional choices you make every single day. Whether you're swiping a debit card, using cash, or charging a credit card, maintaining intentional daily spending habits is the true secret fuel that keeps your starter portfolio growing year after year.
So, we've defined your wealth, structured your budget, harnessed the undeniable math of compounding, and picked the exact index funds to use. The roadmap is literally right in your hands, and your vehicle is fully fueled. So I'll leave you with this one empowering question. What are you going to do with your next paycheck?